Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'm going to be talking about flows to the conventional fund business, a little bit about ETFs later on as well. For the week ended June 5th, 2013, we saw about $1.2 billion in outflows for the week, and actually it doesn't sound like a lot, but there was really kind of surprising events that occurred. First of all, if we take a look at the end of the month, came in with positive returns for the S&P 500 and also for the Dow. In fact, it was the sixth consecutive month of positive returns for the S&P 500. And for the Dow, the seventh consecutive month. And then when we took a look at it, kind of what was been going on, we saw that people at the end of the month were getting very concerned about a couple certain things. Three in particular that we're going to focus on. Tapering by the Fed. They're talking about taking away some of the stimulus that they've had out there on the quantitative easing. Secondly, we've also seen some China slowdown. So some people have been very concerned about the China region and their market actually slowing down and putting an effect on the rest of the market that's been really propped up over the last several years by the Chinese government. And then, last but not least, the concerns about the Abenomics. People have been talking about Japan's new, really aggressive monetary policy that's out there. Certainly people have been applauding it for quite some time. Now there's been some questions in the market of what's going on. Well, let's take a look at what's been happening in the industry and what the flows actually turned out to be. Equity funds actually saw about $500 million of net new money coming to their coffers. We'll explain that because there really was a tale of two cities there. Taxable bond funds saw about $4.3 billion outflow. It's huge. Muni bond funds actually saw about $1.4 billion, something we haven't seen since December of 2012. And last, money market funds actually took in about $4 billion in net new money. Well, one of the ways we can do, kind of deeper dive is take a look at each of the macro groups one by one. Let's take a look at equity funds and see what happened in that group. We saw that they had about a 2.39% negative return for the week. It's the third consecutive week we've actually seen, negative returns, but we still saw investors staying on a steady, put it to work type of mentality. $0.5 billion, about half a billion dollars in net new money came into the conventional fund business via equity funds. It's the 22nd consecutive week we've seen inflows. Now, on year-to-date basis, we're still at some good numbers, $110.7 billion in net new money. Well, let's see how this breaks out, though. Domestic equity funds saw an outflow, about $769 million, while the non-domestic equity funds saw inflows of $1.39 billion. So this was kind of a big move. This is the 23rd and 24th week that we've seen inflows that have actually come into the non-domestic equity funds. So it's kind of amazing. Emerging market funds was kind of the big grabber of attention, though. You'd think that people concerned with China's slowdown and the like, you'd actually see an exodus out of emerging market funds. But again, the China plays are what people are buying. So it's the guys providing commodities and services to China. There's still growth in China, and there's still going to be some returns to be had. They saw about, this again, $748 million in net new money coming to their coffers, the 28th and 29th week that we've seen inflows into that group. So certainly people are still making bets on emerging markets. Now let's take a look at equity ETFs. This is where we saw a little bit different story. Because of this concern that we've been seeing, tapering and cutbacks and people actually being worried about dividend payers and actually being worried about, again, China plays and actually being worried about some other areas of the markets, maybe some of the defensive stocks, people actually saw some big outflows. SPY, the Spider S&P 500 ETF, saw about $2.6 billion in net outflows. And what we saw then after that was the iShares MSCI Emerging Market Funds saw about $2.2 billion in outflows. So this is kind of that defensive area. And last, if you look at the top of that chart, we saw a healthcare select sector Spider stock actually, ETF, actually lose, about a half a billion dollars in net new money coming out of that group. So when we take a look, that was kind of some of the concerns we wanted to take a look at, is who was getting punished, because on the flip side, if we take a look, we actually saw money going into select groups. We saw the ProShares Ultra Russell 2000 basically taking $874 million. We saw ProShares QQQ Trust taking about $598. So investors were very selective in what they wanted to invest into. So really there was a risk-on mentality, but it wasn't into the tried and truths that were paying dividends, that were involved in emerging market and the like. So people are actually selectively putting risk back on in certain areas. Small caps was actually in favor. Let's take a deeper dive now into the fixed income category. And this is one of the areas that we saw a huge impact of tapering by the Fed. We saw that it was the first week in 31 weeks that we've seen outflows, $4.3 billion. That was the largest outflow that we've seen since August of 2011. So that's quite an amazing feat that we've seen that big of an outflow. This is the fourth consecutive week we've seen negative returns in this group, 0.73% decline. And the real pariah turned out to be high yield funds. funds, about $3.2 billion in outflow. This is a record, folks, that we've seen come out of this group. So investors really are going away from longer duration stocks, longer duration fixed income securities, and also from risk. You know, why? If you're going to get a higher interest rate, we know that the Treasury, 10-year Treasury yield actually jumped above 2 and has been above 2 for quite some time. Why would we want to put our money back to work into a higher risk emerging market or high yield group? And so we're seeing this exodus out of long duration and out of riskier assets, because you can go to less risky assets and shorter duration and actually get nice returns. Well, one of the things that we noticed in this area as well is that the loan participation funds took in a little under $900 million net new money. So this wasn't just money flowing out all over the place. People are selectively investing into the fixed income securities, particularly those that have some sort of reset rate, and adjustable rate is what the loan pars are made up primarily of, adjustable rate loans. And this is one of the benefits of going into loan participation funds, is that they can have it. Now, we've been seeing this run for quite some time. It's the 51st week that we've seen net inflows into loan participation funds. Quite a story. Well, let's move on to ETFs and see what happened in that group. $4.8 billion is a record amount of money that we've seen coming out of ETF fixed income funds. Of course, they haven't been around that long, but still $4.8 billion is quite a sum. This is the fourth consecutive week we've seen outflows, and we started off with actually some inflows, and we'll see that it's on kind of the shorter duration, lower risk type of group. iShares of Barclay Treasury basically saw 310. We saw the PIMCO short maturity actually taking about 230 million. And then when we saw the kind of the reversal, we saw a lot of money flowing out. We saw high yield and longer durations actually losing money. So this is certainly a trend that we're going to keep an eye on. Investors are being selective, and they are trying to shorten their duration. How long this will last will probably be dependent on how long we think the Fed will keep holding this kind of will change type of mentality over the market. Right now, people are just waiting to hear what the news are. We had some news come out on unemployment today that was actually a Goldilocks scenario. We saw about 175,000 net new jobs created, but when you take a look at it, it wasn't too bad and it wasn't too good. And had it been too good, we might have seen more of a flight, more of a situation of even more money coming out. But this might be encouraging for investors to kind of stay pat in their fixed income. Maybe not add a whole bunch of net new money into it, but certainly stay pat. Well, let's take a look at our muni bond fund side. They got caught up in this if you will, movement against treasuries, govies, and mortgages. Basically they're considered a safe asset. They're high yield in comparison to their taxable brethren, but when their taxable brethren on the Treasury and Govy side actually start moving up, certainly munis have to as well. So they got a little bit of a spanking. Fifth consecutive week we've seen negative performance. They were down 0.23% for the week, and it's the second consecutive week we've seen outflows. $1.4 billion. This is the largest again since December of 2012. National munis were the pariah of the group. $1.1 billion in outflows. Well, let's go ahead and move on to our money market category. And for our money market category, we actually saw about $4 billion of net new money come in there. It's the third consecutive week we've seen inflows. It makes sense. People kind of sitting on the sidelines, waiting for the employment reports, waiting for some of the big indicators to come out and maybe make a decision. But what we saw is taxable money markets were actually pretty flat. They saw about $0.5 billion of net new money come into their coffers. Here's how it happened. Institutional funds had redemptions of about $5 billion, while retail shares saw about $5.5 billion of net new money come into their coffers. And so the net result is about a $500 million investment. On the flip side, we saw tax-exempt funds actually take in money. They took in about $3.5 billion. That makes sense. People leaving that muni bond fund, like we were just talking about, certainly had a place to park, and they certainly are still concerned about taxes. Well, when we're taking a look at the flows, we actually are looking obviously at weekly events, and a lot of it's just noise. But certainly what people are going to do is keep an eye on what the Fed is doing, employment reports, and anything else that might indicate that the economy is doing too good. By doing too good doesn't mean that we're having problems with the economy. It means that the investors aren't going to be able to look for those deals, and the Fed is not necessarily going to support it with continued quantitative easing. So if we have that happen, we have good numbers come out. Again, this was a Goldilocks story today. We saw that it was not too hot, not too cold. But if we start seeing that there's better ISM numbers coming out and the like, and better growth scenario, it's a possibility they'll start pulling back, and we may see a little pullback in the market as a result of that. Well, if you want to do a deeper dive into some of the areas that you want to go to Lipper US Fund funflows.com. There you can do a deeper dive, or you can join us next week when one of our analysts will be talking about flows for that particular week. Until next time, my name is Tom Rosine, wishing you the best in your wealth planning and creation.